I think companies, and we're certainly advising companies, do your exit planning now. Are you ready? Do you have a due diligence? Could you entertain a sale right now? Do you have customer concentration? You do. Okay, well, let's see about reducing that over time. So those folks are going nuts because it could literally kill their business because that's all they do. They don't have the diversified other products. They're not diversified in that regard. So that's really rough.
Hey everyone, Mario Peshev here. Welcome again to the B2B Growth Hacking Blueprint. And we're meeting Brad Clayton from the CFO Centre, one of my favorite places to look for fractional CFOs and actually work with experienced CFO services, make sure that your business is on par. And we're going to touch on some of the most specific and kind of most painful topics that everyone has in top of mind right now, which is the macroeconomy, the recession, tariffs, of course, working with CFOs in some of these situations that both small and medium businesses and large and kind of multinational organizations are facing right now. Brad, thanks for finding the time to hop on the show. How are you today?
Yeah, thanks, Mario. Yeah, doing well. Good to be here. Good topics we can talk about today, as you mentioned.
These are some of my favorite topics. I'm spending quite a lot of time on them, and every single additional opinion, especially from a seasoned expert like yourself, are more than welcome, and I'm more than excited to talk them through. And before we actually hop on, I spent some time looking at your bio and kind of stalking your LinkedIn profile. This is one of my favorite profiles that I'm seeing here. First off, nearly 30 years, I would say maybe even over 30 years in practice, working at IBM. Well, first software engineering and application engineering, then IBM running product for a couple $100 million, then kind of moving to different areas of business, product marketing, 3 times as a CEO, now kind of one of the key figures, the fractional CFO and regional director of the CFO Centre. And I want to commend you first. And second, I want to say to everyone listening that having a diverse experience from someone who has been in so many seats and someone who wore so many hats is extremely valuable because you can just really speak from the perspective of, hey, this is what engineers see today. Here's what marketers are struggling with today. As a CEO, what the heat looks like exactly firsthand. And this is why your opinion, I find it so valuable here today.
Yeah, no, I appreciate that. And I think there is truth to that because I've been a CEO. And so when I'm working with the CFO Centre with CEOs, I've been there, I've been in those shoes a lot of times. So when you can relate directly like that does go a long way. So that's been helpful. And you're right, I've had quite a diverse background from software programming to marketing to I was in Silicon Valley for a while. I ran an angel capital fund for a bit, which got me into fractional CFO work because I had to make some money on the side because when you're an angel capitalist, you don't make any money. You don't make a 2 and 20 like the VCs do. You eat what you kill, your exits.
Preach.
And after 3 years, when I didn't have any, I was like, I need to make some money. So that's what got me in the fractional CFO world. And I decided I liked it. I enjoyed it. And I started the CFO Centre a little over 3 years ago.
Well, again, I really deem your experience pretty valuable from 2 different standpoints. First, it's a number of different seats you've taken in different roles: engineering, marketing, product management, CEO, CFO, investment as well. So your perspective is extremely diverse. And second, you've also been in business living through several of the recessions that we had over the past 30-ish years.
Right.
You had to, go through the dot-com boom, then the great financial recession, then the COVID pandemic, so to speak, and the recession that we're living in right now. And I'm a great proponent of Ray Dalio and his theory of principles of the changing world order and the fact that cycles are just repeating themselves. So I believe there's a lot to learn about the macroeconomy based on previous events and what we've already seen in the past. So let's start with that for a brief moment. First off, what would you say happened over the past 5 years, ever since COVID came in? We were on the top of the iceberg, record high VC funding and angel deals. Businesses were booming and growing, I would say insanely much. And then suddenly we hit a roadblock for some businesses in 2020, then for some in 2022. So walk us through kind of your perspective, kind of an elevator pitch of how would you explain that to a 5-year-old if you were to recap the past 5 years in the economy?
Sure. Yeah. Obviously, COVID is I guess where we'll start, and that was quite a shock to things. It was interesting though because it revolutionized so many things in terms of remote work, video conferencing, a lot of these technologies that have been out there, telehealth, things like that, that really didn't get the push that they needed. And this was quite the push, right? And so we saw 2021 was actually a very good year for venture capital, a great year in the M&A space. There was a lot of exits. Once we got over the initial shock and people said, oh, okay, we can still have business here, even though we're in lockdown. Funny enough, a lot of innovation happened and the markets were really doing well. And then all that money came into the economy too, right? Through the federal programs. And then it was too much, right? Is really what it amounted to. It was too much money going into the economy. There's cycles up and down. Investor money went into projects, and then they sat back. And so then we had a slowdown. 23 was slower than 22. 24 slower than 23. There has been a lot of bullishness this year, although now that bullishness is slowing down a bit. We saw the market, skyrocket after the November election. I think a big reason for that was the elimination of uncertainty, right? And investors don't like uncertainty. And when there wasn't going to be riots after the election, and now a friendly to regulation, to reduce regulation president came in, there was a lot of upbeat in that regard. But now we're seeing the other side of that, right? There's a lot of pessimism, right? As we all know, it's in the news every day with the tariffs and the overall policies that are coming into play. Whether you're for or against them, it's really just the uncertainty that has, and the speed of it all, that has people pulling back a little bit. And we've been seeing that as well with the CFO Centre. It was interesting, actually. There was right after the election, leading up to the election, it was, at least at the CFO Centre, it was the slowest period I've ever seen, September and October, which usually are booming months. Everyone's coming back from the summer, the fall. Let's have a good end of the year. And I told all the CFOs we're going to have all these great leads, and it just wasn't there. But then right after the election, it was funny. We had more, using this as a barometer, I guess, leads in the first week after the election than we did the 2.5 months prior to that. And things were really good in November and December and January. And then in February, people don't want to make decisions. They want to wait, especially if they're going to be affected, for example, by inflation or the tariffs. They just don't know what to do, or their investors don't know what to do. And so we have seen, just the last month, I've seen 2 companies that had their investments delayed. One was pulled and canceled. The other is just delayed indefinitely. Yeah. And it's the macroeconomic economy, right? It's the uncertainty.
We saw the exact same cycles. We had probably the worst Q4 ever since the past, 8 years. And it was honestly horrid. Of course, kind of both on the agency and the consultancy side, we have a lot of recurring business and just 10-year contracts. So it wasn't something that's going to kill us, but it was definitely wildly concerning. And at the same time, we had the strongest Q1 over the past 7 years. And even the first week of January was packed with sales calls and follow-ups from last year, including follow-ups from the summer. So it was intense. And last week, especially as tariffs were coming back and going in, and we're going to drop them, we're going to delay them, we're going to introduce them back, different percentages for China. It got pretty hectic and people were confused. And I know that Trump has been talking a lot about tariffs being more or less a normal consequence and something that's been running in business and has been happening before. And to some extent, he's also been quoting China as one of the countries that had already been affected by some tariffs back in the day. But as a seasoned and kind of a veteran professional in the finance space, what's your take on tariffs from a historical standpoint over the past 100 years? Whether we are trying to apply the same thing right now, is it something normal? Is it something to be afraid of? Or what are some of the predictions that you see?
Mm-hmm. Okay. Well, you said 100 years. So if we went way back to the tariffs of 1890, I was reading about that in a Wall Street Journal editorial a few days ago. McKinley put in tariffs, and Trump often champions him as one of his role models. But when he was doing tariffs back then, it was different. It wasn't tariffs to punish. It wasn't tariffs to negotiate. It was tariffs to reduce tariffs. It was putting tariffs in place to make a more fair economic situation, to then negotiate to bring tariffs down. So it was a very different approach to the tariffs. And of course, in the 1920s, we had the Smoot-Hawley tariffs which were very instructional about how to not do things during a recessionary time. You don't do tariffs then, right? And then tariffs were just seen since the 1940s as something really not to do, to bring down over time. And everyone was pretty much on board with that, right? Until the first Trump administration, where they put some tariffs in place. There is an interesting story with the Trump tariffs in the first administration he had, and it's the washing machines. It's been publicized. I'll quickly tell that story because it's instructive on both sides of the equation, actually. I think it was January 2018, the first Trump administration put tariffs on washing machines, not dryers, but washing machines. And they were trying to protect Whirlpool and the domestic manufacturers against China and, South Korea, LG and Samsung in particular. And they put tariffs on that was, I think it was 20% up to the first 1.2 million units, and then it went up to as much as 50% on high volume. So they're really targeting Samsung and LG and some of the Chinese manufacturers in that regard. And the results were, not surprisingly, prices went up, right? Went up. I remember the number was $86 on average, about 12% on the cost of the washing machines. What was interesting about that is the dryers also went up in price, not quite as much, but almost as much. They didn't have to. There's no tariffs there. But because washers and dryers have always sold at sort of the same price, they saw the opportunity to raise their prices. And they overall made more money. Obviously raising prices reduces demand, but they were able to it was actually good for them at the end of the day. And the other side of the equation that's not really publicized all that much is that domestic production did go up. LG and Samsung had small factories. They built a new, I think it's LG built a new one. And so it did bring jobs. So that was interesting. Now, the other thing there is they decided they wanted to bring off tariffs two years later, but they didn't come off until 2023. So that's the thing about tariffs, is they're stubborn. You can put them in very quickly, but it can take years to reduce them or take them away. So we'll see. We'll see if that happens here. But that was instructive what happened, kind of in the last wave. And then when the tariffs came off the washing machines, the price came back, and it's now stabilized to kind of where it had been, adjusting for inflation from where it was back in 2018.
Yeah, I feel it's very important to note, and I'm going to double click on what you just said, but introducing tariffs is something that you do quickly, but then taking care of dropping tariffs and reducing pricing and normalizing the CPI in the first place is something that may take a very long time. Some instances, what we see during the pandemic is gas prices maybe rising up, especially with Russia, Ukraine, egg prices going up. But even if the market looks better, that doesn't necessarily mean that manufacturers, producers, supermarkets, everyone else is just going to bring prices down. It requires a lot of pressure and a lot of time to actually bring prices down, which means that inflationary pressure may come in market in about a week or two, but then it may take months, if not over a year, to bring them back down, which is a pretty severe problem that you're dealing with. Additionally, on top of tariffs, because you also mentioned it's as early as the 90s rather. But one of the other caveats here is that I believe that taxes look differently back then as well, just from a sheer portion of taxed income, Social Security, and retirement funds, 401ks. Everything looked different at the time. Can you do like a parallel, at least high level, of kind of how has that looked over the past, let's say, 100 years, and why does the regular American pay a lot more nowadays compared to what we're trying to compare with over a century ago?
Well, it really depends, I think, on the types of products or services, right? Because certainly the cost of a lot of everyday items you would buy, now that they're manufactured in other countries, have come way down in price, right? But the services industry has gone up in price, like healthcare, a great example of that. It used to be a very small proportion of disposable income for the average family. I don't know the numbers now, but it can be as high as, it depends if you have a sick family member or not, but it can be, bankrupt some families, right? If they don't have the right insurance, as an example. And just overall, the cost have gone up, 3 to 4 times the cost of the consumer price index, right? So it goes way up over time. The disadvantage of having the cheaper prices, at least the tariff hawks would tell you, is that Okay, but the people, the middle class is being hollowed out. They're not making any money because that's where a lot of the good jobs were in manufacturing. And so, what's better, having cheaper prices for everyone? That's good. Or is it having higher prices, but allowing the middle class to have good paying jobs that are making those products? And you can make the case on either side of those, either side of that debate. I'm not sure the right answer. I think we want a bit of both, right? But I think we don't want to do it without tariffs, especially the way we're doing tariffs now.
There's definitely the conundrum between liberals and conservatives, Democrats and Republicans. They're always trying to defend two contrasting, seemingly opposite theories, but in theory, they both look for the interest of the people, right? There's just the concept that if you push for a more socialistic future, then everyone's happy, but there's little to no progress going on, and maybe jobs should be companies may be run by the government, and it's kind of a different realm, a different reality that you don't necessarily know that well. On the other hand, we have capitalism, which is unlimited opportunities and lots of growth. However, there's also that middle class, which is growing thinner as the lower class is just growing larger, and that's where we're facing that inequality. So it's something that bothers everyone, and it's really hard to find that balance. And that's why we have different nations with different political regimes and even governments structured on top of that. But considering what's happening with tariffs right now, what's your prediction for 2025? What should executives look for? Where do you think that the wheel is going to turn? And walk me through, what are you generally working with the CFO Centre clients with regards to tariffs and any annual planning for 2025 and forward?
Mm-hmm, mm-hmm. Right. Yeah. What's going to happen with tariffs, right? Everyone's trying to figure that out. I can't say I have a better crystal ball than others. My take, though, I'll throw it out there for what it's worth, is that because tariffs are really affecting the stock market and Trump really cares about the stock market, I think over the next few months, we're going to see the tariff situation start to go away, sort of like it did in his first administration, because the stock market is just not going to respond well to that. There's inflationary pressures. Now the Fed may not cut rates as much. They probably won't as they had before. So I'm hoping that's an ego temperance that will bring off this need for tariffs. But obviously it's hard to say. But as we talked about earlier, you don't just take them right away, right? They will step down, and it could take a year or two for them to go away. But certainly, if the public policy becomes, okay, we're going to stop doing tariffs, that's going to take the uncertainty away, right? And that will certainly help everyone. Now, in terms of how to deal with tariffs, we are advising our clients a number of things, and we're advising CFO centers worldwide. We're in 18 countries, and so a lot of the advisement we're doing is foreign countries. So India, the UK, Canada, especially, what are we going to do? What should we do? Right. So we're helping both US companies and international companies. And it's interesting. It's very different advice, right? Because it's different sides of a trade war, in essence. You have to sort of take your side, or at least advise to the side that you're doing. But, so if you're in the US, and first of all, it's what company are you with? If you're a B2B company, I know, Mario, that's the topic of this show.
Yeah.
B2B companies won't be affected as much. Certainly if you're a service or software company, no tariffs at all. You go on your merry way. You still have to worry about, a recession or other companies struggling. B2B companies that are doing physical goods, well, that's where tariffs could come into play. Steel, aluminum, lumber, these things that are being identified, appliances, things like that. So for those companies that are affected, that do hard goods, we're certainly advising folks to, well, first sit down and do a map of all your suppliers. Where are they? How much of your cost of goods sold is coming from which countries? Look for alternative sources. It's a lot of basic stuff, but if you really need to go through it systematically, because they all come together, they all hold together. Run some scenario analysis, do some scenario planning, what if analysis. Go into the boardroom for 2 hours with your management team and play through some scenarios so you're not caught flat-footed. That's what a lot of companies, right? They don't know what to do. They haven't thought through it. They don't have something off the shelf to pull off and look at, right? So create those volumes that you can pull off the shelf and look at. And then negotiations with suppliers. So we have a lot of our clients right now negotiating with suppliers, and there's been some articles written about that, in general. And so, split the tariff. So if you've got a 10% tariff coming from China, try to split that with your Chinese vendor, 5% each side, something like that. And of course, the big thing is elasticity of your pricing. How can you raise your prices? Some people decide, some companies can't, and they're just going to have to take less margin. Maybe it's very competitive, or other reasons they can't do it, the cost structure. But clearly, that's another thing to look at, right? Is your pricing and diversifying your supply chain.
One very important thing that you mentioned, and I think we should expand on that, is essentially all the tariffs that are discussed so far are related to manufacturing firms and specific goods such as steel and aluminum, and it's essentially the manufacturing and the production side of the business. But right now, there's little in play for service-based organizations, and I can confirm this is what I've seen so far. But I can also say that I'm having a very hard time sleep well at night if this is something that's being imposed to all product companies, but service companies are still left at ease. And some examples that I can provide here is, and I know California is very strong on making laws complicated and making kind of a hard living for lots of different businesses trying to hire in California. Or several years ago, and I think it just kicked in this year, if I'm not mistaken, is the SB 988 kind of regulation for the Freelance Worker Protection Act, and some of the other ways to kind of make life easier for freelancers, however, causing additional burden for companies, and companies potentially looking into offsetting to either W-2s or hiring offsite, or looking for different ways to reduce the legal pain and burden and potential risks by that added kind of legislational nightmare. So with that in mind, I kind of want to hear it from a professional, but do you see a reasonable risk that tariffs are also going to be introduced one way or another for service-based and digital businesses as well? Or does it seem like 100% only product/manufacturing in 2025?
Yeah, I don't see. Yeah, good question. That's a great question. I don't see, Mario, a lot of risk for service companies or software companies. It's just, it hasn't been brought up to date. You haven't seen tariffs historically, and there's already enough pushback on the current tariffs that I don't see that as much of a risk at all.
Because from where I'm standing is, if I'm Trump or whomever's in charge, and I decide to introduce tariffs because this is going to reduce the debt that we have, which is something that's definitely a big deal, right? And why do we want to impose tariffs to China or the European Union? Well, because we want to make the US market more competitive, and we want to bring more jobs, local jobs, and we want to bring more factories and manufacturing happening in the States. So this kind of one side of the funnel of make the US more competitive compared to international markets, make sure that we can provide and produce some goods in the States, make sure that automotive manufacturers are also bringing jobs to the States, and so forth. So on the other side of the spectrum, we also have the very same thing happening for engineering, for marketing, for any type of digital jobs, including, by the way, CPAs living in India and providing registered services for the States as well. And I actually know people who do that. So why put the people in the States working in service jobs in this position compared to outsourced talent, let's put it this way, and not introduce tariffs there? This is just something that's been bothering me for a while. And I'm not saying that tariffs should be introduced for that, but it just seems like the logical next step of the equation,
Well, it does, right? And certainly it's taking jobs away from Americans, right?
Yeah.
If it goes off to the Philippines or Singapore or other countries that are doing call center jobs and other things like that. So you're right, Mario, the logic is there to also do that for the service industry, but it's just not in the mindset, I think, of those that are doing the tariffs. I've been following a lot from Howard Lutnick, who's the Commerce Secretary. I've been reading a lot of what he has to say, and it never comes up. It's always the raw materials like steel and aluminum, or the other hard good products. The fabricated products. It's all hard goods.
Well, That helps me sleep better, even though, of course, I definitely don't want to be in the seat of anyone working in a production business, importing from China and manufacturing in China. But let's get back to tariffs once again. So, on the one hand, Trump's position is we're introducing tariffs to bring the debt down and introduce more opportunities to American businesses to be more competitive, to open up more jobs, and so forth. But realistically, and you said it yourself, that's definitely going to have to lead to inflationary pressure. It's definitely going to hit the market, which is what we see with pretty much all indexes this year. But is there any reality where tariffs stay and there's a slump in the market for a few months, but then things more or less normalize for the most part, which is going to be advantageous for America in the first place?
Yeah, that could play out. That could play out. Tariffs go into effect. Prices go up. Things level out a little bit. I think, so it would be slower growth, as I think what it would be, right? Because we will have inflation if we will inevitably have inflation, right? Literally, prices are going up on the importers. I mean, by definition, there'll be inflation, and so that will slow the Fed down from doing interest rate cuts. So, yeah, I think Mario, that scenario could play out. We just won't have as much GDP, right? It'll be slower growth, is what we'd experience. With maybe half of what it would be otherwise, something like that.
Yeah, this isn't something that looks well from a political standpoint when you're trying to build a legacy at this age, especially. So I think it's less likely, but I just like to hypothesize and kind of build different scenarios and what ifs and why isn't that happening? Is it likely to stay? And I definitely want to consult with a professional while we're here, essentially on the show. So don't mind me asking all these questions to you.
No, that's fine. It's good. This is great dialogue.
What are some of the key issues / challenges that clients are coming to you for fractional CFO services this year around tariffs? Like, what are some of the risks? What's a typical company like? What do they do? What's the main challenge they're dealing? Like, walk us through one or two scenarios of, hey, here's a construction company dealing with this. They know that prices are going to triple. Or here's a manufacturing company or like a real estate company relying on lodging. Just a couple of kind of examples of profiles of companies with you and the most common question that you get from them.
Sure. So there's an auto manufacturing parts company that's right on the border of Canada, and they are completely pulling their hair out because they have parts that go back and forth in the border 5 times. Yeah, right. Because they get the raw steel and aluminum. They make the part. They send it over the border. They put bearings on it. It comes back, and then they put it in an assembly unit. That assembly unit goes into a larger unit, like a muffler, and then that goes into the car. Right. So it's back and forth, and so there's still not complete guidance on that about is it every single time it goes over the border. So those folks are going nuts because it could literally kill their business because that's all they do. They don't have the diversified other products. They're not diversified in that regard. So that's really rough. There's another story. There's another client we have that's in the home construction industry. And what they're facing is it's a double whammy. It's lumber and home appliances, refrigerators, washers, dryers, things like that. And the estimate is anywhere from $7,500 to $10,000 of additional cost per home will just a snap of the finger. And now you're paying more for your home. And that's not helping the home industry, right? Which is already at high interest rates and is having one of its worst times. So that company is just gonna, they don't have. There's no real solution there. They either sell either less margin or raise the price, and they're raising the prices in their homes for the community they're building, right? So it's a dodgy situation. It all depends on your business. Some are, again, like in the services industry, not affected. Others like car parts company, it's rough.
Is there any form of an insurance policy or SBA loans that are kind of more friendly looking towards the tariff situation right now? Like if you're uncertain and you just need to wing it off over the next 3 months or so?
I know the Small Business Administration is taking those into consideration for their loans that they have, but still their standard loans, the 7 and the 504, et cetera. So they haven't started new programs for that. But I think there's a sympathetic ear to that to get them through. But a problem that a lot of folks have is they don't know how to fully quantify the tariff situation, When does it end? Is it going to step down? What happens if it goes over the border more than once? There's not really clear guidance for that. So we're constantly struggling reading the Commerce Department's bulletins they're putting out to try to glean any good information as we can.
Are there, and again, I'm looking into that from the perspective of someone running several businesses, but for the most part, all of them are digital agencies, consultancies, and all of that, and also investing in primarily digital businesses, even though we have some physical ones that are definitely being hit hard right now. No question about that. But from a service business perspective, we are always looking into pivoting and looking for ways to kind of escape from that. And what else can we do? How we can not necessarily take advantage of the situation, but try to make the best out of the situation at the very least. Or if you look into the SWOT analysis, you have strengths, weaknesses, opportunities, threats, and trying to take the threats and turn them into strengths or so. One of the examples that you provided yourself earlier with laundry machines and washing machines, I believe, was that, you try to offset, or kind of one of the products can also bump up prices to compensate for the other, or maybe you can increase the margins this way. I believe that Apple, for example, is a similar company which is making a ton of money from cables and adapters and converters and switches. And it's not necessarily the phone itself, but it's all the other additional tools, and especially cords that are being sold at an incredibly high margin. So are there any other, I know it's not necessarily hacks, but opportunities for similar businesses to look into that? For example, we worked with kind of air purification company for several years. They provided subscription-based service, right? So it's something that you can probably offset and make sure that you sell cheaper now, but there's a subscription to offset price and try to wait a few more months. Or the obvious choice is, of course, just build and manufacture in the States, but for various reasons, this is not always easy, nor expensive, nor cheap. How much have you thought about some creative approaches for product businesses to just think, or maybe even tackle different market? Are there any ways to hedge that off for a few months and potentially, or businesses, let's say a company has a primarily business line producing 70% of the revenue, but there's something that's minor, 30% of the revenue, which is again subscriptions or sheets or something else that's not currently tariffed, that they can triple down on and try to compensate and just hedge that over the next few months. And I know it's very hypothetical and very generic, but just trying to help out more people as we can on the show.
Yeah, I think if you have multiple lines of revenue, I think it's really smart to see, now that there's a new environment where there's going to be higher prices, say for your hard goods, to see about getting subscriptions or software or services, right, where that doesn't have the tariffs. I wouldn't do that if it didn't make sense. But if it makes sense, if something you've been considering, like we want to build out our service business at some point, well, now maybe it's a good time, right? Now maybe it's a good time. The other thing I'd recommend, and we're certainly recommending, is look at other countries that aren't under the tariffs. So if you're going to buy these cables that you mentioned, and you're buying those from China, well, go to Vietnam. They've got an industry there as well that's high quality, and they've been doing it for many, many years. That's what the Trump administration is trying to do, is trying to make these decisions, right, at the micro level to be a macro change. So that's another thing to look at. And I will give one bit of defense, let's say, to the tariff regime, which is one of the things that they're trying to do is with certainly steel and aluminum and some of the other products that are on the chopping board here, or coming tariff board coming up, is defense. Yeah. So if we go to war with China and we're relying on their aluminum, their steel, that's a problem. So that's another thing they're trying to adjust. They're taking, Lutnick talks about, defense of the country, having these certain industries. Now, I don't know if that applies to things like wine, some of the new tariffs that came out, but you can certainly make the argument for some of the things they're putting tariffs on is a national defense concern.
I believe that most of the nations producing wine, such as, let's say, Portugal or Spain, are just too peaceful because they're enjoying the wine quite a lot. So they just don't happen to be of the war type. But I hear what you're saying. And yeah, speaking of picking different countries, by the way, last I checked, Apple was producing 15% of its smartphones in India in 2024. And that's expected to grow to about 28 to 30% by 2027. And I believe this may as well accelerate now with tariffs in China if that stays a little longer. So we definitely see other neighboring countries, especially more Western-looking countries such as India, taking some part of the load. Some contradictory countries, I'd say, like Taiwan, just because they have a very tense political stance with China at the moment, but being used to offset, just as you mentioned, Vietnam right now. And yeah, potentially just looking into other opportunities and other vendors out there is definitely a smart thing to do. One other thing that I again wanted to mention as kind of the side business is what we're seeing on the kind of software digital ecosystem is with B2B SaaS really taking a massive hit in late 2022 and 2023 and even last year. We saw at least many subscription businesses introduced service arm themselves, right? Because they were only used to do raw profit on subscriptions, seat level licensing. But as prices were too steep, and as investors were looking for short-term revenue and shorter customer acquisition cost payback periods, then the smartest possible thing to do is to introduce and kind of onboard some of your engineers to provide white glove services, deployment, delivery, management, integration, augmentation, everything else. Take short-term cash flow, make sure that the product is adapted and integrated properly and not self-made and butchered and not making use of all these licenses. And yeah, that was a really strong move from some of the SaaS vendors. Not many of them were able to adapt, or it definitely didn't look lucrative because, let's face it, service-based margins are low, especially at scale. It's just something that's kind of grueling, hard to estimate, but it's a great way to just offset it. So anything that's related to assembly, construction, maintenance, reviews, changing filters on site or show, kind of providing these as services on site at home is something that can possibly kind of help wave the situation over the next couple months at least.
Yeah, we had a client. It's exactly right, Mario. We had a client that did just that about 2 years ago. And I remember talking to them a few months back now. How did that go? And they were very happy with that because they hadn't been talking to the customer as much as they had in the past. And they used that as an opportunity to really create their product roadmap for the next few years based on touching the client more and spending more time with the client. So they think that it was a very good thing. And so they went from a service revenue of 5 to 10%, they're up to about 20% now. And they actually assigned some of their top engineers that hadn't talked to customers. One of them said hadn't talked to a customer in 3 years and had to go off and do 3 service jobs in a row and came back. And all of a sudden, all this information came in to increase the SaaS product going forward. So there are some benefits to bringing on service lines, more prominently.
I was just trying to look up Domino's stock price. I know at some point in time they were really struggling and the stock was going down, and then they had a kind of restructuring, and suddenly it went up to the sky. But I'm going to look up the data and be prepared for the next show. Couple more questions that kind of stood out before
Sure.
we kind of look into wrapping up. But what are some of the trends that you kind of see impacting B2Bs in 2025? Not just about tariffs, but based on the macro outlook over the past 5 years. Stock market, the Fed's direction, the new Republican president, the war situations with Israel and Ukraine. Generally speaking, if you prepare for roadmaps outside of just tariffs, where would you see we are headed? Are you bullish? Are you bearish? How do you?
Generally, I'm pretty bullish. Generally, I'm pretty bullish because of the private equity markets. So there is different calculations on this, but one calculation I saw was that there's $3 trillion with a T, $3 trillion on the sidelines waiting to go in. And most of that private equity to do acquisitions and investments, right? Strategic investments. And most of private equity money is use it or lose it. If you have a fund and you don't use it within 3 or 5 years, it goes back to the LPs. So there's going to be a lot of pressure to move private equity money into companies. And they love recurring revenue, private equity, right? And they love business services. So I think companies, and we're certainly advising companies, do your exit planning now. Are you ready? Do you have a due diligence room? Could you entertain a sale right now? Do you have customer concentration? You do. Okay, well, let's see about reducing that over time. So I think that's one of the big trends to look at over the next couple of years. I mean, last year, second half of last year, private equity had higher exit values, the companies they acquired, than strategics. And that's never happened before. And that's because of all this money on the sidelines that private equity has trying to move in. We get calls all the time from private equity groups looking for companies, so they're really digging in and trying to find. They're competing with each other, you know. So I think it's a really good time to be a B2B company, a SaaS company, but put yourself in position though when you get a knock on the door, because the knock will go away pretty quickly if you're not ready, because you got to entertain these things and move when the market's hot. So that's one big trend for sure. I think another trend that we're seeing is, and of course, maybe this is biased because I live in this world, but is bringing in fractional executives and this is something that's good at any time, but certainly in a recessionary environment, right? It doesn't have to be CFO. Obviously, I'm in the CFO mode, but whether it's fractional marketing, fractional sales, HR, rather than hire a full-time person, or if you have a full-time person leaving, maybe you can fill that role with someone that's working, 2-3 days a week, or half the time or 2/3 of the time during the week, and you pay them less. And if you get the right fractional person there that have the right mindset, they will be part of the team. They're not a consultant from the outside, and they act that way. And so you get the benefit of having that full-time person, but with a lot of flexibility and not paying as much. So that's another trend that we expect to see more in 2025.
On the fractional side of things, fully agree with you. I also have fractional CMO, even CEO roles, by the way, which is pretty exciting. But in some cases, the founder's transitioning, or they've been acquired and they need different perspective, or there's a preparation for an exit, which was kind of the first part of the conversation. So I just saw the business a year ago jumping in as a fractional CEO to prepare the business for exit. So this was precisely what you're talking about. We also work closely with Flippa. I'm an ambassador kind of on the European side of things, and they just introduced Flippa Invest, which is bringing even more investors into kind of a private equity type of deal. They literally just introduced it several days ago. And there's a lot of capital that's just more or less frozen right now. Ray Dalio used to say cash is trash, but that was prior to the previous recession. Right now, he's not so convinced in that. But let's say this week gold is performing well, right? But up until 3 weeks ago or so, S&P was just cruising and scaling so fast. So it's really hard to just predict, and just investing in businesses yielding quarterly dividends is a really strong value proposition. Real businesses, not fictional crypto or like digital that you don't know whether they're going to disappear overnight. It's an extremely strong value proposition that I couldn't stress on that enough. And because you mentioned the fractional CFO, and that's definitely something that we see, there's more demand into that. And I even see that in companies that have CFOs who come from let's say an accounting background, or kind of a more traditional, just bookkeeping, promoted to someone who has a seat on the table, or just someone who's been with the company for 20 years in the boardroom, but not necessarily in touch with kind of all the other dynamics. So what would you see is the right size business, right type of arrangement, or what are the top 2 or 3 kind of most popular plans, so to speak, working with you that kind of our audience can take advantage to if they recognize themselves as someone in need for your services?
Okay, sure, great. Well, to bring a CFO on, the company needs to be a little bit more sophisticated. So we don't tend to work with ground zero startups. You need a controller, maybe, or bookkeeper at that point. But once you have revenue coming in, then it starts to become viable to bring a CFO in. So we like to say it's a range of a low of $2 million in annual revenue up to $100 million in annual revenue, kind of a wide range. But it does tend to be, I would say, 80% of our clients are in kind of the $5 to $30 million in annual revenue, kind of the Goldilocks, right? Not too small or too early for a CFO, but not so large that they need a full-time CFO, right? So that's where the ongoing part-time fractional CFO works pretty well. We do, though, have another service, I guess you'd say. It's leveraging most of the CFOs on the team. We call it CFO's CFO, which as the name would indicate, is a CFO for the CFO. So it's a peer relationship with a CFO. So our typical ongoing CFO relationship is reporting to the CEO in the $5 to $30 million, say, kind of company. But the CFO is more middle market, $100 million or more kind of company, where the CFO in place just doesn't have the time or the skill sets or the bandwidth to do it all. And so we bring in one of our CFOs on a project basis, 1 month, 3 months, 5 months, 9 months, maybe to diversify or to do a fundraising for a subsidiary company or whatever that CFO in place can't get done, we can get done. So that allows quite a range, I guess, of companies that we could work with. And we have a number of programs. We have programs for companies coming over from international. We have a thing, CFO Essentials, for the newly funded company, what to do, 40 best practices. So we have a lot of themes of why to bring a CFO in. But the two main services might be the ongoing CFO and the CFO.
I really love it. What I can say is we did transform from some of these large retainers just working as kind of an addition to the team with a, even having a seat at the table with a fractional on our end. But right now, especially over the past year, we see a lot more demand for done with you. It's not done for you. You just offload and, you don't want to pay attention to that. But there's a lot of strategic work that needs an additional set of hands, but also an additional critical thinking and someone who's definitely in line with the needs of the business. And there's a lot more demand, especially over the past year. So I can absolutely see the CFO for the CFO type of business being in high demand right now. And I'm absolutely going to ask you to just provide links to these services or something else that we can link in the show below. Excellent chat, Brad. Really, thank you for stopping by. Lots of great points, incredible perspectives, and definitely someone deeply embedded and kind of involved in the macroeconomics and kind of what we expect in 2025. I'm really with you in terms of we do expect a strong year ahead. It's been a couple of quiet years, even due to the turbulence going on right now. The outlook is very positive. We saw that earlier this year, and I believe this is just a temporary slump that we're seeing now, but things are definitely going to move in the right direction. So kind of as a wrapping thoughts, tell us, where can people find you? Like, are you posting online yourself? And also, where can they go to find out more about the CFO Centre?
Sure. Thanks. Thanks for that last plug, I guess, Mario. I appreciate it. So, the website's probably the best place to go. We are international. We started in the UK, so we spell Centre the UK way. So it's www.cfocentre.com. So that's how we spell our company. And that pretty much has everything there. I can provide you afterwards, links and my contact info. Be happy to have a conversation with anyone.
Amazing. Thanks again for making the time. Really great insights. We are going to post that and also going to provide some additional snippets that you can also share with your audience here. Thank you for stopping by. Everyone who listened, please, if you have any additional questions, drop them in the comments here for Brad. I'm going to make sure that he sees them. And definitely look up the CFO Centre services, because there's a lot of turbulence going on right now. Additional consulting is always going to be of help. Thanks for stopping by, and see you in the next episode.
Great. Thanks, Mario. Appreciate it. Great call today.
Cheers.